So you've probably heard some of the buzz lately, right? About banks getting into crypto.
Yeah, it's definitely picking up steam.
But we're not really talking about, Bitcoin trading here. It's
Yeah.
more specific, something called stablecoins.
Exactly. And it sounds technical, maybe a bit dry, but honestly, this could really change the basics of how money moves.
And maybe even where you keep your money.
That's a huge part of it. We're seeing a pretty big strategic shift in banking. It's happening faster than a lot of people think.
Okay, so that's what we're doing today. A deep dive into stablecoins, how they're shaking up traditional banking.
Yep.
We've looked at analyses from places like Ledger Insights, FinTech Weekly, TreasurUp, Bank Director.
Plus, reports from the big banks themselves, JPMorgan, Citi, others, they're all weighing in.
And these sources, they lay out the strategies, the opportunities, but also the threats, right? The real risks stablecoins pose to, well, the banks you use every day.
Absolutely. It's a double-edged sword for them.
So our mission here is to unpack this. What are stablecoins, really? Why are banks suddenly paying such close attention now?
And what does it all mean for the financial system, the one you interact with?
Let's start with the basics then. What exactly is a stablecoin?
Okay, simplest terms. It's a digital token. But the key is, it's designed to keep a stable value.
Stable how?
Usually, it's pegged one-to-one to a traditional currency. So think $1 or €1.
Ah, okay. So if it's pegged to the dollar, one token should basically always be worth $1. Not like Bitcoin where the price is all over the place.
Precisely. That stability is the whole point. And it's important to distinguish them from CBDCs, central bank digital currencies.
Right. Those are issued by governments, by central banks.
Exactly. Stablecoins, though, they come from private companies. Could be a fintech, could be, well, increasingly, it might be a bank itself.
And this isn't just some tiny experiment anymore, is it? The market's grown.
Oh, far from tiny.
Right.
We're talking a market cap over, $208 billion already in early 2025. And the forecasts? Pretty optimistic. Some are predicting global circulation hitting almost $2.8 trillion, maybe by 2028.
That's huge potential growth.
It is. A lot is still used inside the crypto world, sure, but the real story now is how they might break into, everyday payments, mainstream stuff.
Okay, that scale makes sense. But banks kind of ignored digital assets for a long time, or seem to. Why the sudden change? Why are they taking stablecoins so seriously now?
Well, a huge driver is regulation, or at least the push for regulation, especially in the U.S.
You mean like actual laws being proposed?
Yes. There are bills in Congress, the Genius Act in the Senate, the Stable Act in the House. The idea is to finally create a clear legal framework for stablecoins, especially the ones used for payments.
And is there political will behind this?
Seems like it. The current administration has actually said that establishing U.S. leadership in digital assets is a priority. So that's definitely speeding up the legislative process.
Okay, and I saw that Genius Act, the Senate one, just got over a procedural hurdle recently.
It did, which suggests it has real momentum. And what's interesting in the latest version, something bank lobbyists were pushing for, is new restrictions.
Restrictions on who can issue them.
Yeah. Basically, making it harder for non-financial public companies to issue stablecoins. The argument being, if it acts like money, it should probably come from a regulated financial player, like a bank.
Makes sense from their perspective.
But, like any big legislation, it's not final. The details are still being hammered out, negotiated, so there's still quite a bit of uncertainty for banks to deal with.
So clearer rules are making banks more comfortable? Maybe. But it's got to be more than just ticking compliance boxes, right? You said they see it as both a threat and an opportunity now.
Oh, absolutely. Their whole view has shifted. They went from dismissal to seeing this as, a fundamental strategic issue.
Right. Let's talk about the opportunity side first. How can banks actually, benefit from stablecoins?
Well, for one, it's a chance to claw back some ground they've lost.
Lost to fintechs.
Yeah, fintechs, crypto firms. They've been nibbling away at traditional banking for years, often with faster, slicker payment systems. Stablecoins give banks a tool to fight back on that front.
Faster payments, cheaper payments. Is that the main thing? Especially like international transfers.
That's a really big one. Think about old school wire transfers. SWIFT. Slow, expensive, lots of steps. Takes days sometimes.
Yeah, definitely not instant.
Stablecoins could potentially settle payments in seconds. And they work 247, 365 days a year. Plus, the cost per transaction could be way lower. For businesses dealing internationally, that's huge.
Okay, and this ties into something called programmable payments, using smart contracts.
This is where it gets really innovative, especially for corporate banking. Programmable payments mean money moves automatically when certain conditions are met.
Like what? Give me an example.
Okay, imagine a payment automatically releasing the moment a shipment of goods arrives in port. Or payments for factory output triggering automatically when a certain production level is hit.
Is this actually happening? Are
Yeah.
banks doing this now?
They are, yeah. JPMorgan's Onyx division, using their Connexes network that used to be JPMcoin, they're already processing over $1 billion a day in institutional payments this way.
$1 billion a day.
Yeah. They've got clients like Siemens using it to automate payments tied to industrial machine output. And Citi did pilots with Maersk, the shipping giant, triggering payments automatically when ships refueled using their Citi token services.
So it's moving beyond just theory.
Definitely. It's operational for big companies now.
Okay, so clear benefits for businesses using bank services. What about new revenue streams for the banks themselves?
That's the other big piece. Banks see several ways to make money here. One, they can issue their own stablecoins, backed by dollars or euros. Bank of America's CEO basically said they're ready to go once the rules are clear.
Okay, issuing their own. What else?
Custody. Holding these stablecoins securely for clients, both corporate and maybe even retail eventually. If billions are held in stablecoins, someone needs to safeguard them. Banks can do that.
Makes sense. They already do custody for other assets.
Exactly. Third, conversion services. Helping clients swap easily between regular money and stablecoins, or even between different stablecoins.
Like an exchange service.
Sort of, yeah. And fourth, providing all the traditional banking services, custody, brokerage, lending to the companies that issue stablecoins. Think about Tether. They hold massive amounts of U.S. treasuries as reserves, servicing those reserves. That's a potentially huge business for banks.
So they're basically using their existing strengths, trust, infrastructure, regulation.
Absolutely. Banks have that established institutional trust. They have deep expertise in compliance, KYC, AML, sanction screening.
Know your customer, anti-money laundering.
Right. All that stuff is critical for preventing crime. And banks already have robust systems. By offering stablecoin services through that trusted, regulated channel, they can stand out from maybe less regulated crypto players. It feels safer to businesses and consumers.
And I heard some buzz about the biggest U.S. banks maybe even teaming up.
Yeah, that's a potentially massive development. Reports suggest JPMorgan, BofA, Citi, Wells Fargo, they're exploring creating a joint stablecoin.
A joint one. Why?
The idea seems to be to build their own compliant, large-scale alternative to the stablecoins already out there. Maybe even build it on top of existing networks they already run, like Zelle or the Clearinghouse. It's a defensive and offensive move trying to build their own rails for this new world.
Wow. Okay. So the opportunities seem really significant. Faster payments, new services using their trust. But what about the other side? The threats. Why are stablecoins making bankers nervous?
This is where it gets potentially really disruptive for their old model. The biggest fear, deposit disintermediation.
Meaning money leaves bank accounts.
Exactly. If people and businesses start holding significant money in stablecoins instead of traditional checking or savings accounts, that shrinks the pool of deposits banks use to make loans.
Which is their core business.
Right. And the threat gets even bigger if stablecoins are allowed to pay interest, which is actually a point being debated in those regulations we talked about.
Less money in accounts means less fuel for lending. That hits their bottom line.
Definitely. It also threatens their fee income if stablecoins catch on for everyday shopping or for those international transfers.
Then banks lose out on credit card swipe fees, foreign exchange fees.
Precisely. Those fees add up. And they're facing direct competition for those transactions now.
From who? Fintechs.
Fintechs, crypto firms, maybe even big tech. Imagine if Apple or Amazon launched their own stablecoin, built into their ecosystems. That's direct competition for your money, your transaction.
That would be huge.
And it also competes with banks in that banking as a service space, where banks provide the back end for fintech apps. Companies like Stripe are already pushing into stablecoin accounts, trying to win those fintech partnerships away from banks.
Okay, the sources we looked at really seem to emphasize the threat specifically to community banks. Why are they particularly vulnerable?
Yeah, that's a really critical point. The worry is that stablecoins could cause deposits to shift within the banking system away from smaller banks.
How?
Well, the reserves backing these stablecoins, the actual dollars they often need to be held in super secure, large-scale custody accounts. That usually means the money flows to the giant Systemically important banks that specialize in custody, like State Street or BNY Mellon, they'd hold the big pooled reserve accounts for the stablecoin issuers.
So money could effectively drain from local community banks and end up concentrated in these huge Wall Street institutions without the customer even realizing it.
That's the fear. And there's another way deposits could vanish if issuers are allowed to hold reserves directly at the Federal Reserve. That's sometimes called narrow banking.
What does that mean?
It means the money would leave the commercial banking system entirely. It wouldn't be available for lending by any bank, big or small.
And most community banks,
Yeah.
they just can't issue their own stablecoins to compete, right? They don't have the tech or resources.
Generally, no. They'd likely lack the scale, the specialized tech, the regulatory budget. It's a huge lift. That's why groups like the Independent Community Bankers of America, the ICBA, have been sounding the alarm.
Lobbying Congress.
Loudly, urging lawmakers to put guardrails in bills like the Genius Act to prevent this community bank disintermediation. Their concerns might have even played a role in some of the recent procedural roadblocks that bill faced in the Senate.
So this isn't just theoretical. What happens if community banks really do lose a lot of deposits?
It could be devastating for their lending. Community banks are crucial for funding small businesses, farms. Local economies depend on them. If their deposit base shrinks, their ability to make those loans shrinks too. It hits the heart of their business model.
Sounds like a classic innovator's dilemma for the whole industry then.
It really is. Banks face this tough choice. Dive into stablecoins, invest heavily, maybe even hurt some of their existing profitable businesses in the short term. Or hold back, wait and see, and risk getting left behind as fintechs and crypto companies build the future of finance without them. And they're not just competing with startups. Established players like Circle with USDC or Paxos, they already have significant infrastructure and partnerships. They're tough competitors.
So it's clearly not simple for banks to just jump in. What are the main roadblocks they face?
Well, just the implementation is incredibly complex. Think about that joint stablecoin idea among the big banks, getting multiple massive institutions, each with its own legacy tech, its own priorities, its own risk appetite, to agree and build something together. That's a huge challenge.
Yeah, I can imagine meetings. And what about security and compliance?
Critical. Banks have fortress-like security for their current systems. They have deep compliance teams for KYC, AML, sanctions. They need to figure out how to translate all that rigor to the blockchain world. It operates differently, has different vulnerabilities. It requires new skills, new tech, big investments.
And if they don't issue their own, they have to vet the third-party ones.
Exactly. Which stablecoins do they support? They need to do serious due diligence. How is it backed? Really backed? How easy is it to redeem for actual dollars? Is the issuer transparent, regulated? It's adding a whole new layer of risk management.
Okay, let's try to wrap this up. We've covered a lot. What's the big picture takeaway from this deep dive?
I think the main thing is stablecoins aren't just a crypto sideshow anymore. They're looking more and more like they could become fundamental plumbing for global finance. Banks see that. They see the need to modernize, the chance for new revenue, the ability to use their trust advantage.
But at the same time, they're facing these really serious threats to their traditional way of doing business. Losing deposits, losing fee income. It could reshape banking as we know it.
It really feels like a crossroads for the industry. They have a choice to make. Do they actively jump in, invest, try to shape how this all unfolds, become central players in digital money?
Or do they hesitate?
And risk stablecoins basically bypassing them, being offered by fintechs, big tech, whoever moves fastest.
And the roles banks could play are pretty clear, right? Helping people convert money, holding stablecoins securely, managing the compliance headaches, giving advice.
Absolutely. They have valuable roles to play if they choose to step up, which really brings the question back to you, the listener. As money gets more digital, where will you interact with it? Will it be through your bank, the institution you already trust, with all its regulation?
Or will you end up using services from newer players, maybe fintech apps, maybe tech giants, channels that might operate under different rules?
It really sets up this sort of battle for the digital dollar. How that competition plays out, banks versus fintechs versus crypto firms, it could fundamentally change what money and banking even mean over the next few years.